So from a private markets perspective, which I think is what we're going to be talking about a lot on that panel, I think a lot of it is just continuing to invest in the areas, the long-term secular themes that we've liked for a number of years.
And they are?
So digitization, energy transition, enterprise software, these secular growing businesses that have stood the test of time. So we like these things pre-COVID, during COVID, when you had to re-underwrite and looked at the areas that we were investing in, it still made sense. And then as you move into a more inflationary environment, some of these long-term themes continue to make sense irrespective of the environment.
So digitization, energy transfer, and the third was enterprise software,
healthcare. There are a number of these long-term secular themes, and you don't want to get distracted by the day-to-day machinations of the 10-year or the day-to-day machinations of the FX markets. These are long-term secular themes that we continue to invest in.
You've just closed a nearly $10 billion fund. How has the capital raising environment changed this year? Has it gotten harder or what?
Yeah. So yes, thank you for mentioning this. We just closed our private equity fund. This is one of a number of funds that we are raising as part of a series of capital raising goals that we set out 2.5 years ago that we're tracking well ahead of. In terms of the capital raising environment, I think you have to break it down into the different sources of capital. And I would say it's certainly gotten harder over the last 6 months. And there are a couple of things driving that. In the institutional investor base, the U.S. institutional investor base, they have an allocation towards alternatives. It's a percentage of an overall portfolio as both their public equities and their fixed income has come down in price. They find themselves overweight or more overweight than perhaps they wanted to be in terms of alternatives. So their propensity and desire to want to invest or re-up or make new investments has certainly slowed. I think, again, the long-term secular theme is still there, but it's a bit of a moment of a pause after a period where they'd made significant allocations. I think
so it's not a function really of whether people like the business or the businesses that you would be investing in. It's more a function of changes in other parts of their portfolios.
Well, you have to look at the individual investor. Yeah. They will typically have a strategic asset allocation model that says we want to be in a certain amount of public equity, a certain amount of fixed income or bonds, a certain amount of private equity. They may not be there immediately, but over a period of time they will work to move their portfolio towards that allocation. And with private equity, it's hard to make real, vintage bets or timing bets. You tend to want to leg into it at a consistent pace over a period of time. But what they've seen right now is as their public markets have come down, they've gone up in terms of private markets positions. So their propensity to want to re-up will be slower. Yeah. Insurance, on the other hand, I would have said up until a few days ago, still had a fairly keen interest in growing alternatives allocations. And then retail, I think, was still in the early innings of